Dividend growth investors, bonjour, Mike Hiru here. It is finally this time of the year, and no, I'm not talking about buying gifts for Christmas or the holiday season, but the quarterly earnings for Canadian banks. So last week, all the big banks reported their earnings, and there was a lot of things to unpack. So today we're going to look at the 6 big banks. We're going to look at EQB, we're going to look at GoEasy, and we are going to end this video telling you a little bit more about what is wrong with BMO these days. So let's get started this review with the year-to-date returns. So that includes the capital appreciation, so the stock price plus the dividend. And to my surprise, CIBC is the big winner this year, up by more than 50% year-to-date. Kind of crazy. I did not expect that, but just to put everything under perspective, last year CIBC played the bank playbook perfectly, which was increasing the provision for credit losses to the highest point possible, disappointing investors, and then this year it's coming back saying, oh, well, it's time to recover some of the PCLs because we did not lose all that money, so here comes the earnings growth. Long story short, it was a good quarter for CIBC though, and you can see that the regular winners such as Royal Bank and National Bank were still at the top. Bad mention to TD, we're going to talk a little bit more about this one, but of course a pretty rough year, only down 10%, assuming of like what happened with the anti-money laundering investigation and their results. But on the other side, when you compare at all the other banks, the lag is huge. So I did a comparison with ZEB, which is BMO equally weighted bank ETF. So you have the big 6 equally weighted, which pretty much match the market. So the Canadian market was up 25%. The banks in average were up by 26-27%. And what do you find lagging behind? Well, the covered call on banks, which is exactly the 6 big banks, but you're writing covered calls on it. So by definition, when you write covered calls on an asset, if the stock price goes up too fast, you are forced to sell it at the price of the options, meaning you're leaving money on the table. This is exactly what we see. So yes, the covered call ETF pays a higher yield, but whenever banks are going up big time, well, you are going to leave money on the table in terms of total return. So the capital plus the dividend is still less if you go for the yield options versus just owning the 6 big banks. So it's exactly the same investment, 2 different strategies. One is leaving money on the table. So just want to highlight that because a lot of investors seems to forget that and makes that mistakes. Now, going on to the results, which is the most important part, right? So first, quick overview on the dividend increase announcement. We have a lot of those. So National Bank, Royal Bank are increasing their dividend twice a year. Same thing with BMO. So up 4%, 3% for BMO. So that was great. CIBC that skipped the previous dividend increase came back strong with a 8% dividend increase this time. So you can see that things are turning into their favor. As I said, provision for credit losses were a lot better this quarter. So that opened the doors to more flexibility in terms of increasing the dividend payment. For TD, it was disappointing because this bank does not increase its dividend twice a year, but rather once a year. So now we're going back into that CIBC Scotiabank mode over the past few years, up only 3% for this year. We understand what's happening. We're going to talk about it in a second, but just up 3%, pretty much matching inflation. So that doesn't look that good for TD. As for Scotia, well, they already announced that there would be no Christmas gift this season. So no dividend increase in 24. They will review their earnings and their strategy in 25 to see if they are able to pay more dividend. In terms of earnings per share, well, we have like very different result from one bank to another. So we actually had 2 big guys winning here. So CIBC at plus 22, Scotiabank at 27, and even Royal Bank that we can consider that it was a pretty solid quarter at plus 16. We had National Bank that did only up 8%, which is usually the one that performs a little bit better. This time was a good quarter, but not that great. Keep in mind, though, that the provision for credit losses has not hurt them so much, and they have been running on such a solid bull run for the past few years. It's only normal that right now they're not necessarily outperform all the other banks in terms of like one quarter for the earnings per share. What was quite disappointing, though, is TD at -6 and BMO at -35. That's definitely a big drop here. We'll have to go into the segments to see what really happened over there, but I'm telling you, it doesn't look good for BMO so far. In terms of payout ratio, well, of course, with a big drop in the earnings per share, BMO is now the tightest type of bank to pay dividend at 83% payout ratio. We're going to have to see if it's going to continue this way in 2025. Again, it's all about PCL. So if they get PCLs under control, as CIBC just did this year, they're going to smoother down the earnings. They're going to go back up, and then the payout ratio will fall into order. What struck me while I was looking at the payout ratio is usually all Canadian banks are around 50%. And right now we have CIBC, National Bank, and Royal Bank that are still on pace with that 50% payout ratio. But now we have TD, Scotiabank, and BMO that are all more than 60% of their earnings being distributed. So no surprise here that TD slowed down on their dividend increase policy and that Scotiabank had completely paused it. So maybe BMO is going to follow that train. We'll have to find out in the next quarter. So now let's move on to the results per segment. So for National Bank, it was a good quarter overall. So we have like the classic banking activities at +2%, personal and commercial. So we have wealth that definitely drove that quarter up 17%. Higher revenues, higher fees. That was pretty much the deal here. Capital market did well at +6, and US international. So Credigy in the US, Cambodia in international up 8%. So we see that they are showing some strong stability in terms of growth over there. For Royal Bank, it was a story of including HSBC assets that pretty much drove the overall returns. And there was also a huge impairment in wealth management last year that was not here this year. So of course, it drove like another 500 million in earnings. For capital market, they were flat. So if it was not for some accounting impairments and the HSBC acquisition, the quarter would have been pretty much stable. Now for TD, well, TD got slapped big time by the DOJ. So after the investigation for the anti-money laundering problems that they had in the US, they got slapped 3 times. First time with a fine, so over $4 billion in fine. They had that as a provision. So yes, it's a big bill to pay, but they expected that. But after that, the most important part is now they are capped in the US, which means that they are not allowed to grow their assets. And there's no expiration date on this penalty. So they're put in the penalty box, but it's like not a 2 minutes for cross-checking, but rather like a 10 minutes, maybe a 25 minutes, maybe like game misconduct, maybe like 5 years there. We don't know how long they're going to be in the penalty box, but long story short, 1/3 of TD's business is in the US, and their major growth vectors were actually found in US soil. So how they're going to be able to get out of this mess, it's going to be a big problem. Plus, they also are under heavy scrutiny, which is totally normal. But when you have the compliance department on your back on every single transaction you do, well, everything takes longer. You have clients that are not satisfied, and it's going to cost a lot more for operations. So I don't expect much growth for TD for the coming years. For BMO, well, we do have a big problem with provision for credit losses. Those losses are kind of like out of control right now. I told you that last quarter. It is the same story this time. So this is why he's now starting to struggle. We're going to look at that at the end of this video, but definitely that PCL graph doesn't look good. For CIBC, as I just told you, up 13%, PNC up 32% in the US. Last year, it was the opposite. They had to report very strong provision for credit losses in the US. this year they're just recovering what they had as a very bad quarter last year. Now it's becoming a very strong quarter this year. So we have a good part of like the bank is recovering. Is it going to be the same thing next year? We'll have to see. So don't get too excited right now, but it's still a good old bank. So don't have to worry too much, especially when you look at what TD and BMO is going through. CIBC seems to be in a better position. Finally, Scotiabank. I'm not a fan of this one. I told you that many times, but I must admit this quarter was good. So on the Canadian side, up 7%. On the international side, up 11%. And on the wealth side, up 10%. So very strong quarter for Scotiabank. I hope that they will be able to bring a little bit more stability from the international segment. So everything that is in South America. We'll have to see how it goes moving so far. They are on a recovery path, but keep in mind that if the Canadian market as a whole is up by 25%, pretty much everything is up by 20-25% as well. So it's not a super great outperformance, but still they're doing well. Now, a quick review for EQ Bank, a much smaller bank. We cannot really compare the big six to EQ Bank and GoEasy. That's why I'm doing a small segment on those, but I do not compare them exactly. It was a record year for EQ Bank, more than $1 billion in revenue. That was the first time. That was amazing. A great year overall for the past 12 months, but the last quarter was not that great. Earnings per share dropped by 34% on higher provision for credit losses. So you can see that the theme is recurring, right? This hurt a specific segment, which was equipment financing portfolio. Management said they took action right away to control more risk and to avoid this problem going forward. Good news, they also increased their dividend quarterly. So another quarter, another dividend increase, up 4% this quarter. I think they're up like 23% for the past 12 months, which is kind of crazy. So every single quarter in 24, the increase was from 4% to 7%, depending on the quarter. So very generous, low yield, high growth stock. Keep in mind, it's still a very small bank. We're still looking very good on prom night. So just be a bit careful about that. Follow the PCLs because this time it hurt the earnings. Will it be the same story in the next quarter in 25? This is the type of metric you need to follow going forward. Management said because interest rates are going lower, consumers should have more money. They expect to originate more loans and make more money moving forward. So they were quite optimistic about the future. We'll see if they're right. GoEasy, revenue up 19%, earnings per share up 26%, strong loan origination again. Keep in mind, GoEasy is usually the type of business that will lend money to consumers that are not getting it from the bank. So they're not like A consumer, they're maybe like B plus B because they have a very strong underwriting process, but still again, you have to be very careful about the charge-off, so the money that they lose on loan. Their targets, it's usually between roughly like 8 to 10% of their loan should be fall into the charge-off, so losing money. This quarter, it was a bit higher than usual, so we're at 9.2. Still in the target, so they're still profitable, they're still running the business model as they should be, but 9.2%, take a look at that numbers for the next coming quarters because maybe we're going to see more people defaulting on their loan. So it's getting closer to 10%, not the end of the world, but again, looking at the charge-off for GoEasy, looking at the PCL for EQ Bank for Q1 2025 will be two very important metrics to still look at. Speaking of provision for credit losses and tracking those numbers, I've been reporting this for a while. Last quarter, I've showed you that number as well. But look at the PCL ratio. So that is like the provision for credit losses on the loan portfolio. And you can see that this amount does not only increase by millions of dollars, but it also increased in percentage for BMO. And this is what the market is concerned about. So we started last year with a PCL on impaired loans of 25 and then 0.27% on total PCLs. And it goes up to 38 and 44 and 54 and 91 in Q4. So they must take their PCLs under control. Maybe they're running the playbook of banks. I told you many times over the past years, banks tend to be ultra conservative and they like to lower expectations and then over delivery. So they might be telling you next year, oh, don't worry, everything is fine. And now we're making more money and we did not lose all that money into our provision. So now we have like provision recovery, boosting earnings up. I hope it is the case. But right now, this graph doesn't look good. As a comparison, we can take a look at the graph at National Bank. So I told you at the beginning of this video, it's normal that National Bank does not show like super huge earnings per share growth. Well, it's because their PCL, as not being in recovery mode or not being in increasing mode, it's pretty much stable. So it was like 0.21% back in Q4, and now we're up at 0.27. So not too bad. It's really under control and really stable. A big difference between the other one that went up to 0.91. So to conclude on this video, I would say with a lower rate in 2025, we should see maybe a smooth landing. Who knows? I'm still worried a little bit more about getting into a recession in Canada. I'm not convinced we're going to get away from this because all the economic data right now are not looking that strong, but you never know what's going to happen. The key, again, if you want to invest in Canadian banks, is to A, understand their business model because they are all very different now, and B, looking at financial metrics. Don't just invest in one bank telling yourself they're going to be fine. They've been paying dividends for the past 100 years and it's all great. Well, things have changed a little bit over the past 100 years and maybe they're going to change again in the future. So what was true yesterday may not be true tomorrow. So all right, guys, let me know what is your favorite bank. I'll see you in the comment. Don't forget to like and subscribe to the channel to not miss my next video next Thursday. And until the next video, don't forget to stay invested.